The UK government realised too few employees were contributing to a pension for their retirement. Hence, new laws came into place to ensure all employers enrol their staff into a pension scheme. This is the biggest shake-up of the UK pension system in over 60 years. Auto-enrolment is an initiative which is asking all employers to automatically enrol their staff into a qualifying pension scheme. This comes under the Pensions Act of 2008 and is enforced by the pensions regulator. As an employer, this will affect your business in three different ways. A. Managing the initial setup and compliance of your workplace pension. B. The cost to your business for the pension contributions. And C. The ongoing administration and management of your workplace pension. The initial setup and compliance work of your workplace pension can be divided into 4 steps. Step 1. Find out and establish your staging date. The pensions regulator would have written to you and informed you of your staging date. The staging date is when the regulator thinks this new law regarding workplace pensions comes into effect for your business. The more employees your company has, the sooner your staging date, and the lesser employees, the more later your staging date. Stage 2. Assess employees for who to auto-enroll and when to auto-enroll. Your employees will be broadly categorized into 2 different categories. Category 1, eligible employees. These are employees who are aged between 22 and 65, earn above £10,000 per annum, work in the UK. These employees must be automatically enrolled in a pension scheme. Both you, the employer, and employee will have to make contributions. Category 2, non-eligible employees. These are aged under 16, earn under £10,000 per annum, they work in the UK. These employees don't need to be automatically enrolled in a pension scheme, but have the option to opt in if they want to. If they do want to opt in, the same as Category 1 would apply. That is, both the employer and the employee will need to make a contribution. If an employee is a temporary contractor, an agency worker, or an overseas staff, you, the employer, will need to assess into which of the above 2 categories the employee fits in. This will mostly depend on who is actually paying the labor of the employee, for example, the employer directly, or in the case of an agency, the agent. Also, the earnings definition used by the pension regulator to categorize staff as either eligible or non-eligible is much wider than the standard definition and includes wages, overtime, bonuses, commissions, statutory sick pay, statutory maternity pay, and even car allowances in certain cases. Therefore, you will need to assess employees at the staging date, when an employee joins your company, on the employee's 16th and 22nd birthday, when employees received opt-in notices from the pensions regulator directly. The bulk of your initial work would be done assessing your employees one by one and categorizing them into either eligible or non-eligible employees. A good up-to-date payroll software, which should contain all the necessary employee details, for example, their date of birth, pay details, etc., would be able to categorize your employees for you and help with the administration process. The second part is to provide a qualifying pension scheme for your employees. The third stage, you will then need to register with a qualifying pension scheme. This can be an existing scheme, which your company already has, or it can be a brand new scheme you take up with a pension company. Whichever you choose, you will need to certify the scheme with the pensions regulator so it is authorized. Or you can use NEST, which is the National Employment Saving Trust. NEST is a workplace pension scheme set up by the UK government. It is free to use and is set up specifically for auto-enrolment. It is also fully authorized by the pensions regulator. The fourth step is, once you have completed these steps, you must inform the pension regulator that you have completed all the above steps and you're good to go. You will do this by visiting www.tpr.co.uk pensions.gov.uk/online declare. And using your PAYE reference and letter code, which will be found on any letter pension regulator sent you, you will be able to declare that you have completed all the necessary steps with the regulator. The second part to consider is the cost to your business for the pension contributions. The contributions paid into the pension scheme will be phased out as follows. From now up to March 2018, it will be 1% by the employer and 1% from the employee, therefore 2% total legal contribution. From April 2018 to March 2019, it will be 2% from the employer and 3% from the employee, a total of 5% legal contribution. And from April 2019 and onwards, it will be 3% from the employer and 5% from the employee, a total of 8% legal contribution. If you wish, it is possible to reach an arrangement with your employee where you pay the full contribution, with the employee paying nil, as long as the total legal contribution limit is paid in full. In your company's books, the pension contributions made will be recorded as a journal entry. A journal entry is not a payment or a deposit transaction, but a record which usually affects multiple accounts in your company's books. For example, every time your company's monthly payroll is processed, a journal entry is made in your company's books, affecting both your company's income statement and the balance sheet. A journal entry will make a debit and credit entry in your company's books, and it must always balance. That is, the debit must equal the credits. The pension contribution your employee makes will be deducted directly from his monthly or weekly earnings, shown on his payslip, and paid automatically through the company's payroll. The pension contribution your company makes for your staff will be recorded as an expense of your company and will go straight to your company's income statement. Since the pension contribution will be recorded as a journal entry, the balance of the contribution will go to a pension fund account on your company's balance sheet. This credit balance will remain as a creditor of your company. When your company makes its pension contribution payments to the pension scheme, this payment will be recorded against this credit balance and reduced to nil. Each time a payroll is run, your company's pension costs will increase and a creditor will be created. At the end of your company's accounting year, the total pension contributions your company made will be totaled and treated as a tax-deductible cost to the company. As the statutory minimum pension contributions increase each year, so will the pension costs of your company. The third and final thing to consider is the ongoing administration and management of your workplace pension. With this new pension law, there will be a new set of administration work you, as the employer, will have to do. You will have to regularly check and monitor your staff for auto-enrollment. From time to time, your employees may move between the two categories from being non-eligible to eligible and vice versa, depending on changes in their monthly or weekly pay and age. You will also have to process any opt-in, opt-out and joining requests your employee may make. Also remember, an eligible employee will need to legally first be entered for auto-enrollment, then will have a month to opt out from the scheme if he or she wishes to. You will need to keep accurate records of your staff. All employees and pension records must be kept for a minimum of at least 6 years. To better manage your workplace pension, you will need a robust and up-to-date payroll software which can act as an interface or middleware between your company and the pensions regulator. This will greatly reduce the administration work needed and prevent any filing deadlines from being missed. It will also track and monitor the auto-enrollment dates and process. It will be used to communicate the pension requirements, details, and contributions with the employees. It will also provide the necessary documentation and reports for the pension regulator in case of an inquiry. If you have staff that are employed for a temporary period, say under 3 months, or after your initial assessment believe they will be categorized as non-eligible staff, you can go for the 3-month postponement option. and not need to opt in the staff into the pension scheme. However, this option will need to be confirmed by the pensions regulator in writing. You must also avoid inducements and prohibiting activity for your employees. As an employer, you can be fined for discouraging new and existing employees from opting into a scheme. The pension regulator will enforce full compliance of your pension scheme. Non-compliance could result in escalating penalties. To conclude, for a more in-depth discussion and advice on how to set up your workplace pension and how it will affect your business, contact us on info@claremans.com.